Today we unpack the enormous opportunities of African food companies buying from smallholder farmers and selling into the local regional markets. The continent could easily feed itself, but is a net importer of food. The opportunities are simply gigantic, and the investments of today's guests show that, growing 50 to 100% year after year. Currently, the portfolio holds 25 companies which work with 100,000 smallholder farmers, and we learn why the traditional VC model doesn't make any sense here, and a holding company model does, plus why and how he wants to take the holding company public in a few years' time. This is the Investing in Regenerative Agriculture and Food podcast, Investing as if the planet mattered, where we talk to the pioneers in the regenerative food and agriculture space to learn more on how to put our money to work to regenerate soil, people, local communities, and ecosystems, while making an appropriate and fair return. Why my focus on soil and regeneration? Because so many of the pressing issues we face today have their roots in how we treat our land and our sea, grow our food, what we eat, where and consume. And it's time that we as investors, big and small, and consumers start paying much more attention to the dirt/soil underneath our feet. To make it easy for fans to support our work, we launched our membership community, and so many of you have joined us as a member. Thank you. If our work created value for you, and if you have the means, and only if you have the means, consider joining us. Find out more on gumroad.com/investinginregenag. That is gumroad.com/investinginregenag. Or find the link below. Welcome to another episode, today with Luni Libes, 30-year serial entrepreneur turned investor, author, and teacher. Welcome, Luni.
Oh, thanks for having me on.
And to start with the personal question, how did you end up focusing on ag and food on the African continent?
Happenstance, not a plan, although my mentor always told me to make it a plan. But I started a business accelerator 10 years ago called Fledge, focused on mission-driven for-profit companies, what we would now call impact companies. And so any impact anywhere in the world, we started investing in companies twice a year, every year. By the time we got to 2020, we covered all but one of the SDGs. Like our companies, when you ask them what mission were they solving for, you would get 16.
Which one was missing? Like number 17?
We never picked an education company.
Okay.
Kind of part of the story as well. And there was no majority of them. There was no majority anywhere. It was about 104 companies after 8 years of work. And the biggest grouping of them was food and ag companies in Africa. And so that's how I wound up in food and ag is picking them 7 at a time, twice a year.
And how come somehow for somebody who's not based in Africa, based in Seattle, you ended up with such a strong emphasis or focus on those type of companies, food and ag companies in Africa? I mean, did they happen to find you a lot? Did it just the message or the method of you investing and working with the methods of Fledge did it really connect there or click? Like, what's the reason? Because it could have been education in Southern Africa or Southern America or Southeast Asia.
Anything. Yeah, it could have been clean tech. It could have been healthcare. It could have been, there's 17 SDGs. In hindsight, it's really clear why. In the very first cohort, we had some African companies, right? Despite the fact we're a little tiny accelerator in Seattle. By the time we got to the fourth cohort, half the companies we invited in were from Africa, but not all food and ag. But in hindsight, it's really clear why. So there aren't a lot of great programs in Africa and still aren't 10 years in. And so we get great deal flow because we are serving that market. And then in Africa, the biggest industry by far is food and ag. So we get a lot of applications in that space. But really what drives it is the fact that we're picking companies as an investor. So Fledge is investing in every company we invite into our program. And when you're an investor, you want to pick the ones that are most likely to pay you back, most likely to make you money, right? In addition to the impact. And so when you sit down and do the analysis on the business side, not the impact side, we can it's hard to debate which is more important to the world: better healthcare, better education, better food, or enough food. But when you go on the business side and you do some analysis and you say, okay, well, what's the target market? Well, we do commodity crops. We don't do cash crops. We don't do coffee and chocolate and other exportable crops. We just do, corn and rice and bananas and chickens and fish. And so the total addressable market for those types of foods is everyone. Everybody eats every day, or everyone wants to eat every day. Most people eat more than once a day. So the total addressable market for a food company is the population of the country where the company is running, if it's, again, commodity food that's edible in their country. And if you do anything else, if you go and look at education, well, then the addressable market is half the population in Africa. Half the population's under 18. If you look at healthcare, it's who's ever sick at the moment, which is a smaller subset. So just on the first glance, the total addressable market is bigger for food. And we don't have to debate, do people want to eat? We don't have to debate whether or not the product fits the market need. Of course it does. It's food. Everybody eats. And so whenever we had a choice between, not every single time, but very often when we had a choice, do we bring in this company doing ed tech or do we bring in this company doing food? If there were equal impacts, we would pick the food company. And that happened over and over and over again for 8 years until we had 25 companies doing food and ag in Africa. And only then did we notice the pattern.
And so what is the pattern in terms of, because food and ag in Africa is still very broad, you say commodity crops only, did you start seeing like, okay, within this 25, 5 or 10 or whatever the numbers are really successful and they all share like this similar DNA or they share this similar conditions? And so what was the success pattern there?
Yeah, that's a good question. So the very first one we brought in this pattern was East Africa Fruits. Mm-hmm. It was a 1-year-old company.
Quite famous now, but yeah, back in the day not.
Yeah, it was. This is 2014. So in 2014, it was 1 year old. The founder had taken $4,000 of his own money and earned $100,000 in revenue and broke even in year one. And so just that fact, how do you take almost no money and turn it into a $100,000 a year company in a single year, and don't lose money?
And don't spend $1 million. Yeah.
Just seeing that in the application pool, we said, well, we have to see what that is. We have to invite that one in. And if he could do that with $4,000, we gave out $17,000 investments that year. Now it's 20. But what could he do with $17,000? And so we invited that first one in. And that is a little extreme, but it's indicative of what we've seen in the rest of the companies, which is they all take the form of, they took a small amount of money, more than that, $10, $20, $30, $40, $50,000, and they took it and made a company that was earning more than the investment. So earning $50,000, $100,000, $200,000 when we met them. And then with the expectation through our due diligence process that they could at least make $1 of revenue per dollar of investment. And it's proven out more like $2 of revenue per dollar of investment in profits. So that's the commonality. If you look at all the companies, you'll see, they're run by native African entrepreneurs. We don't do expats. We did a little bit in the early days and we don't do it anymore. That was a mistake. So they know the problem at hand because they grew up with that problem. They're capital efficient at what they do. And they had some proof before we brought them in. No company was idea stage when we invited them in to Fledge, at least not for those companies. And they've been proving that out. So one thing we show off from this part of the portfolio is all those companies combined in 2016 earned cumulatively across all the companies like $1.6 million that year, which, is a nice sized company, but it wasn't one company. It was 25 companies. 2021, so 5 years later, those same companies plus a few more that the same founders started. They're parallel entrepreneurs. But that same group of companies earned almost $17 million, 16.8, I think, precise. So they grew tenfold in 5 years. The reason why, right? Again, the reason why I'm doubling down in this space is because the opportunity size for these companies, Well, let's go two sides. One, on the impact side, there's a huge need for food in Africa. The continent grows enough food, but they lose it by the time it gets to retailers. And so they're a net importer of food as a continent. So we need to solve that problem. And then on the business side, there's an opportunity to solve that problem and more. There's an opportunity for Africa to be an export region, feeding the global north. And that opportunity size is not a factor of 100 bigger than these companies are now. It's a factor of like between 1,000 and 10,000 in that order of magnitude. So these companies have already grown 10x, and we're not looking and asking, if they grow 10x more, is that all they have? No. They got a growth stage in front of them that's 100x or 1,000x before competition gets in the way.
And how do you invest in them? Like, what is the structure that you chose to do this? This sounds VC type returns, but it's not the structure you chose to put money to work.
So we actually use two structures. The way we found these companies, again, is through the Fledge Accelerator. Mm-hmm. And so it's impact in general, all different impacts. Many companies applied, depending on which city and which year. Most recent for the Seattle program was 845 applicants from 85 countries applied. And we picked 7. And we happened to pick 6 of those were African. Didn't have to. 1 was American. And then in 2020, that was up through 2020. And then in 2020, we changed the structure. So we changed the structure and we launched a investment holding company called Africa Eats. And we moved all of the Fledge investments into Africa Eats in exchange for shares. So Fledge is the owner of Africa Eats. And then we raised some more money on top of that. And so the new structure is answering the question of how do you scale up their questions? How do you scale up these companies? How do you actually achieve that 100x growth, 1,000x growth? How do you raise capital for these? They're SMEs. That's the general term. They're small and medium enterprises. They're not tech startups. How do you raise capital for them in an efficient manner? And the third one is, how do investors get back out? And so in the VC world, in the standard tech VC, 60-year-old style of investing, investors get out by having the companies be acquired. And that works somewhat in the tech space. It works somewhat in some other spaces, but we've just never seen these kind of acquisitions in Africa in any market, and basically zero in food and ag. So we didn't bet on that.
That's not a way out. Yeah.
Yeah, there's a lot of funds out there that are still expecting that to happen someday, but we're not. So I looked around. I like to find models that worked elsewhere. And I basically asked the question, what would Warren Buffett do? How would Warren Buffett do this? He's not an investor like VC style. He doesn't just expect his companies to be acquired. In fact, he has the opposite philosophy, which is he buys companies. One of his pieces of advice is, if you like a company, buy it and don't sell it. Just own it. It can be the whole company. It can be part of a company. He does both. And so I asked the question of my crowd, like, well, what would happen if we owned a small piece of all these companies? Let's just call it a quarter of all these companies. And we owned it for 100 years or 200 years or forever. Then what? How would you get your money back out as an investor? That doesn't sound good for investors. But again, Warren had the answer, which is you take the investment company public, like Berkshire Hathaway. Anyone who wants to buy Berkshire Hathaway and his portfolio can do so. You go to the public markets, you buy some shares, you own a piece of that portfolio. So we do the same thing in Africa Eats, but we just haven't gotten to the public. We're not big enough yet to have done the public offering. We'll do that in the next few years.
So how long, or what are the steps for you? Because I'm not saying easy to say we're going to do an IPO, etc., but it's not easy to do, or at least I don't think so. It's quite easy. What are the steps for you to take this 25 or this holding company public in the next couple of years? What still needs to happen?
Yeah, it's really strange. It's not that common, and therefore it seems to be a risk. But in fact, it's just a matter of scale. So we've spoken to multiple organizations that run public markets in Africa and the London Stock Exchange. We've spoken to multiple investment bankers who do that process. We've spoken to public equities traders who would buy this kind of stock. We've spoken to the institutions that would invest in an IPO. There's nothing actually holding us back except scale. Like, we're just not big enough yet to merit doing that step. And so when we're big enough, when these companies are earning, easy on the London exchange, when the value of our portfolio is 100 million pounds or $100 million now, that's big enough to go public in London. And there's 127 other African companies that are already there. And there'll be 150 probably by the time we get there. You just have to, go through the motions of getting your accounting in order, which we are already doing because we know we want to be in a public company. Getting your legal side in order, which we're already doing because we know we're going to go down this path. And then filing the paperwork and doing a roadshow.
And is there any risk to going public?
The only risk is that now you have a price attached to your company, and the market can bring that price down whether or not your company is doing well or not. Like you suddenly are in the ocean and you don't control the tide. But again, the companies we have in our portfolio historically have been growing 60% year over year. The value of our portfolio is growing 60% year over year. And the markets don't move up and down that much. Like, they're volatile. They're not volatile. So we do expect that this will be like Berkshire Hathaway, where when we go public, we're expecting when we get to London, the price per share will be $6, $7, $8. And that's like what it was at Berkshire Hathaway in the 60s. And now those shares are $400,000, like just from the growth. And we're taking the rest of the Berkshire Hathaway model with us as well, which is no dividends. We don't extract money from these companies and hand it to the investors. We'll never hand out a dividend. We simply recycle any cash that ever gets generated into more growth. And we just expect this to keep growing for the next, again, 100, 200, 400 years.
And in terms of ag, I mean, of course, we're on a regen ag and investing podcast. We talked about the investing piece, which we're going to explore further. But what do you see on the ag companies, the food companies you're involved in? How important is the issue of soil health and how to deal with that? If you're like looking at 100, 200 years, it seems quite obvious, but is it already current for many of the companies you're investing in and basically partly owning?
Like 99% of all the agriculture that happens in Africa eats is organic. Not certified organic, because that costs money, but following organic practices. And it comes out for two reasons. One, because the entrepreneurs we're picking to back are ones that care. They care about I missed it, but they're all working with smallholder farmers. We don't do we're not investing in the actual farming. We're investing in companies that buy from smallholder farmers and train them. And so the people we're picking care about the environment. But really what it comes down to at the moment in Africa and why organic is so prevalent is it's cheaper. Like, I just saw Bill Gates speaking yesterday, and maybe he spoke earlier this week about how organic is just too expensive. I don't know where this man lives. He's like he's living on another planet.
Not that far from you, I think, in Siena.
I know he lives like 20 miles from here. But his perspective.
Knock on his door. Go and have a conversation about tech and soil and stuff, because I think there's something to maybe take him on a trip.
I would love to take him on a trip. Because the reality is that the smallholder farmers, and there's 200 million smallholder farms in Africa, about half the population is farmers, or more than half the population. They just can't afford the chemicals. Like, they don't want to put on chemicals on their property. Well, maybe they do, but they just can't afford them. So part of why the yields are low is that they're doing organic farming, but part of it is because they only have an acre. Like, a typical smallholder farm is an acre. They can't burn up an acre with too much fertilizer and too many pesticides and too many herbicides. If they do that, they're done. Like, they're already poor, but that would put them totally on the below subsistence farming. Like, they just can't do that. They have to treat their land well because that's all they have.
And the companies you invest in, like, are there any examples of taking that further from trying to get the yield up with organic inputs, with pushing in terms of seed selection, etc. Because of course there's a lot you can do without going the extreme chemical and let's say fossil fuel based input route. Do you see that happening, or is that really out of your realm basically?
It's below my level of detail that I jump into. So I don't need to know as the investor which seeds that they're choosing to plant in Tanzania as maize. Like I don't get down to that level because there's hundreds to pick from. Some of our companies are using a model where they give the inputs to the farmers. Most of our companies are using the model where they're just buying the outputs, but they know what the inputs were. And then I have one company that sells seeds, and only one company. So
and is the current like input crisis or the price levels? I've seen some reports of I think it was in Ghana where suddenly, of course, the interest in let's say non-imported fertilizer, meaning compost, meaning skyrocketed. Do you like the current political situation and the prices that come with that? Do that affect your companies at all, or because by definition they're not using very expensive and inputs coming from outside, they're sort of shielded from that? Or what do you see? We're talking November 2022, and prices are still of inputs extremely high. Do you feel that, or do the companies you invest in feel that, or not so much?
Probably. I have heard, we have WhatsApp groups with all these companies. We talk to them all the time. And yeah, we heard fertilizer prices are way up. That's a problem. We're going to see growth this year is probably only going to be 50% instead of 60%. And I don't know what percentage of that drop is due to fertilizer and animal feed prices going up. That was a similar issue. And I don't know what percentage of that is just our companies are getting bigger, and as you get bigger, you tend to grow slower. Like it's hard. If you got $1 million year company, getting from 1 million to 2 million in a single year is a big leap. Getting from 1 million to 1.5 or 1.6 is an easier leap. And so as they get bigger, they grow slower. But we didn't see anybody get smaller because of fertilizer prices or animal feed prices.
And do you see that as an opportunity as well, or your entrepreneurs to replace expensive inputs?
It came up. Do we have enough pieces in our portfolio to solve the problem of animal feeds? And the answer at the moment is no, we don't. And then the other issue is that Africa is humongous. And so even if we did have all the right pieces, and we were missing protein as one of the pieces, just shipping it around, even the East African companies in East Africa, is just too big. It doesn't make economic sense. We then the price of transport would overwhelm the savings.
Which also the price of transport exploded, so that doesn't help either. Basically,
yeah,
meaning
diesel went up by a lot. Yeah.
So. Can you start a local but regional, basically animal feed provider by mixing in the different ingredients needed? But it just didn't turn out to be feasible.
Yeah, this is another interesting part of our model. So we're not a fund. We're not a VC fund. We're VC-esque, but we're not a VC fund. We're not 10 years. We're not just looking for companies and then spinning them away, right, or having to be acquired. We're permanent. We're a holding company. And so when something like this pops up, we sit down with our entrepreneurs, and not just one at a time, but in groups, and we try and figure out, is there an opportunity here? And if so, who in that group is going to put their hand up and take hold of that opportunity and run with it? Or which 2 or 3 companies are going to work together on that? And so we have done we have some preliminary work on joint ventures between companies. And we have one spin out that's up and running and another that's coming. And so we're kind of excited about the kind of things that can pop out like that, without having to find an entrepreneur who's already solving it, and without having to do this, without the private equity fund style of, okay, we'll hire a team and we'll go do it ourselves. So we can't solve every problem this way, but we're working on some opportunities.
And on average, talking about the impact, of course, average is horrible here, but what's the difference for like a typical smallholder farmer working with one of your companies? Like, what's the selling to one of those? Like, what is the impact for him or her with his or her 1 acre?
If they're selling us honey, we have 5 honey companies. If they sell us honey, their income is growing by like 50%. 50.
So of the 25, 5 are honey companies. That's an interesting.
Honey is.
Who would have thought that? Yeah.
Again, these kind of things kind of pop up. We found one, we liked it. We found another, we liked it. One of them got started by one of our entrepreneurs. The reason we like honey is it's one of those things that's an extra. Like the farmer was farming whatever they're farming, and then usually what happened is the government gave them a beehive, or the government subsidized the beehives, or in many cases the farmer just learned about this and just bought the beehives, and so they got some beehives somehow, and then our company are also aggregating the outputs, right? So the farmer doesn't have to worry about how to sell the honey, which is nice. We take care of that for them. And that's the general model of most of our companies is we buy the outputs for the farmer. They get an income. They don't have to worry about anything else after that. So we're buying the honey. Their income goes up by 50%. They're still doing whatever they were doing before. It's just bonus income. On the food side, when we're actually buying the main product that they're growing, we're growing their income by at least a factor of 2, sometimes factor 3. Biggest is factor of 5, depending on what the company is and what the crop is. So that's typically taking people who were subsistence farmers and giving them the median income for that country, or a little higher than that. So, we don't have hard numbers on this for every farmer. We do for about 25,000 farmers, but not for the 100,000 farmers we work with. But in the 25,000 number, we're seeing they're earning $1,000 a year, $1,200 a year. Whereas before they were earning a few $100s a year.
Which is massive differences, yeah.
Oh, yeah. Yeah, it's the difference between I can definitely pay all the fees for the kids. They all have shoes. They can go to the doctor when needed, right? And everybody eats every day. Like between that and I'm not sure if my family will have a good life for the next season.
And what are you missing in terms of companies or entrepreneurs? Like, of course, you're not picking them and then finding them to build it, etc. But what are you from now until the IPO? Like, what are some companies or crops or like approaches you would like to add? Is there something you're missing on that matrix of, quite honey heavy, but let's say in general, is there something you would love to add if you would find it?
The biggest thing that we see is logistics. So again, this a lot of the things we describe as Africa Eats, a lot of the learnings in the 2.5 years we've been doing this is really just listening to the issues that the companies are dealing with, one at a time or in groups, and seeing patterns and then acting on solutions. And so one of the biggest learnings I've had, it's taken a little more than 2.5 years, but in doing this work, all the companies when we first found them were $100,000, again, $50,000, $100,000, $200,000 in business. None of them had a truck when we met them. The way you do business, and these are logistics companies, by the way, right? So they are literally buying food from farms, bringing it to a processing plant, and then distributing it to retailers. That's the basic business model. And they were doing that without owning any vehicles. And you can do that in Africa because there's always a guy with a truck. That's or the man with the van is the aphorism. And so that's what they were doing. They were finding the guy with the truck, calling him up, and moving stuff around. And
I hope they show up.
Men. Yeah. It's men with trucks, and they'll show up eventually. And it really eats into your margins because you got to pay them and a markup. And so very early on, even 2018, 2019, just before Africa Eats, a lot of the fledged follow-on investments were equity investments to buy trucks. And we just saw this transformation in these companies, they would jump up by a factor of 2 or 3 or 4 or 5 in terms of revenues as soon as they had their own vehicle, and their margins would go up on top of that. And so that was the clear path. And then that East Africa Fruits Company, that one that was $100,000 in 2014, it was $5 million last year. And right now they have, I don't know, about 80 trucks in their fleet. Like, they had to build out a logistics system because there wasn't one to hire. Like, the guy with the truck's fine, but when you need 5 trucks, it's hard to find. So one of our companies in Rwanda, Paniel Meat Processing, 4th largest meat processor in Rwanda, in the pandemic shutdown, he couldn't do his main company. So he's an entrepreneur. He found a guy who had 4 extra trucks he wasn't using. So it wasn't trucks for hire, it was trucks to lease completely. And he created a logistics company, the first refrigerated logistics company in the country of Rwanda. And this was just at the time that Africa Eats was starting. Got it up and running, earned a teeny bit of money in 2020. In 2021, with no new investment, actually no investment whatsoever into this company, he did $500,000 in revenue with 5 trucks. So Africa Eats, we invested in February this year. We invested enough to let him buy 4 more. That and the profits net, we now have 13 in operation in that company. And it's, I think it's about $1.5 million so far by November of this year. So it'll be a little more than $1.5 million with a total investment. I think we put in $200,000 in February. And those trucks got more learnings. Those trucks are not just driving around Rwanda carrying food for a handful of companies. They're driving all over East Africa, picking up and delivering food for hundreds of companies. All of a sudden, we discover this opportunity exists not just for our companies, but for many, many, many others. So, we've seen this as a pattern. The question is this a Rwanda thing or is this an African thing? And it seems to be an African thing. It seems to be that everywhere we look, the same missing piece of the infrastructure is there. And so we are in the process of spinning up an equivalent company in Tanzania, spinning out of East Africa Fruits. We know there's a need in Western Kenya where we have 2 companies. We know there's a need in Uganda where our seed seller can't find enough guys with trucks. And so we're building out a brand that we came up with, Africa Eats came up with, it's called Truck, TRUK. Stands for Tanzania, Rwanda, Uganda, Kenya. It's the 4 major countries of East Africa, but it sounds like truck. And so we're building out Truck across these 4 countries to start with, and then beyond that. And it's just filling in a huge gap that we're seeing. And that gap will then help the next wave of companies that are doing food and ag in Africa, get bigger faster because they don't have to build that out too. And especially, they don't have to go raise the money from the global north in order to buy all those trucks.
Which is not the most efficient way to do it. Yeah.
Yeah, it's so much more efficient to have, a few really big companies, 1 per country, that can attract, commercial capital. We don't need impact capital for trucks. We just need commercial capital for trucks.
And so what would you tell, for sure you talk to a lot of investors, let's say, that are potentially interested in these kind of opportunities, but are on the fence in the global north. Like, what is your main message to them? And what would you like people listening to this as well walk away with as obviously not investment advice, but as the main lesson learned or the main message to remember after our interview of about 50 minutes?
Yeah. So I would say that probably most of your audience has never invested in Africa and probably has never even considered investing in Africa. And the thought of investing in Africa just scares them to not act. And what I would tell you from being a startup investor in Africa for 10 years is it's just like investing anywhere else. It doesn't seem to be any more risky than me here in Seattle investing in Portland, Oregon, or Dallas or Atlanta or anywhere where I can't like physically just go in an hour and go see the office. Investing is investing. Common law is common law. The British left lovely legal systems all over the world. the opportunities over there are so much bigger than they are here. And it costs way less to grab those opportunities than it does here. So, I was a techie. I was in the tech space for 20 years. I see the massive amounts of hundreds of billions of dollars being thrown into the tech space. And it just flabbergasts me that somebody thinks there's another opportunity out there for the next Google. Maybe there's one or two more, but there isn't thousands. And yet thousands of tech startups get started. But there's definitely huge opportunities over in Africa in food and ag, $1 billion opportunities. And you can get in on, $100,000 checks and see 100x growth on that, or bigger checks if you have more money. But again, the opportunities to see 1,000x growth are all over the place in Africa, and I don't see any of them in the States.
And so how do you do like the accountancy from a distance? Like SMEs globally, absolutely not just in Africa, are not famous for their paperwork or keeping track of anything. You'll be surprised how extremely disorganized many SMEs are, and thus very difficult to raise funding. How do you tackle that?
It's a global problem. That is not an African problem per se.
No, absolutely not. It's everywhere. Any SMEs, I would urge you to walk in anywhere, and you'll be surprised about the non-existence of Excel, even in many cases.
Yeah, so we know this, and we plan for this, and we work around this. So I often describe, I think I did a blog post on the Africates website. I said, here's the recipe. We're one part venture capital, we're one part business accelerator, and we're one part Berkshire Hathaway, in food and ag in Africa. That middle part of business accelerator, right? All these companies, all these founders chose to come to a business accelerator. That's how we found them. They all knew they needed help. They all knew that they didn't have all the answers, which is, again, vastly different than the world of tech. And so we've trained them in what it means to produce financial reports. And I can't say that we train them perfectly and they all produce great reports. That's not true yet. But as part of Africa Eats, what we do is we check in on them constantly. We require them to report to us on a quarterly basis what their financials are. We review all that. We review their annual audited financials, because in most countries, you're required to submit audited financials. When they're out raising money, and most of them are trying to raise money, when they're out raising money, they're sharing with us their forward-looking financials, and we're reviewing those and giving our feedback on that. And we're about to launch a service where we're going to just do the financials for them. So what we've learned in teaching them over and over and over again what it needs to look like is they still don't always get it. And so we're just going to hire a small team of bookkeepers and accountants and just offer to them that we're going to do their books for them. And we're going to show them what it means to have a CFO. We're going to show them what it means that on Monday morning at your management meeting, you have an actionable financial report, as opposed to your auditor gave you a report from 6 months ago, which is generally what they're doing right now. And our expectation is once they have actionable financial reports, their growth will speed up, which is one reason. A, we're doing it because it's the right thing, and B, we're doing it because we think their growth will speed up. And if their growth speeds up, then our portfolio is worth more. So we're investing.
It's probably needed for the IPO at some point. Yeah.
Yeah. So we're that part of Berkshire Hathaway meets business accelerators. Sometimes the answer isn't cash. Sometimes what they need is something beyond cash, and if we can provide that, we'll provide that too.
And probably it's a nice bridge actually to a question I'd like to ask on a magic wand. So if you could change one thing, but really one thing only overnight, could be in food and ag in general, could be in Africa specifically, could be or could also be globally, what would that be?
Can I just put 2 more zeros on the end of the bank account in Africa?
Yeah, you could, but But what would you prioritize? Right? I asked this question because I want to know what would you prioritize if resources, I'm not saying are unlimited, but are pretty limitless in this case. $1 billion is still a lot of money, even with these inflation numbers.
Yeah, I'd say the only problem we're facing at Africa, the only real problem we're facing is lack of capital. So this could be 100 company portfolio in a year if we had the capital. It could be 1,000 companies by the end of the decade if we had enough capital. We could be working with tens of millions of farmers if we had enough capital. This model could solve the problem of Africa being a net import continent, if only for the capital. Like
so that's the biggest. Sorry, I was mixing up questions of magic wand and $1 billion, which you also answered. Like you would just add a few. Like that's the missing link here. It's extra capital to accelerate.
That's all we're missing. Yeah, of course we'll need a bigger team to
that comes with capital.
That, but that's easy and relatively easy. And just to show, we didn't talk about the Land Accelerator or that side of the work. One of the fledged programs that's still running, even through the pandemic, was the Land Accelerator with World Resources Institute. Mm-hmm. And that's a program focused on restorative agriculture, restorative forestry and agriculture, and mostly winds up being tree-based crops, so fruits, nuts, things like gum arabic, things that grow on trees, edibles that grow on trees. And we had 1,400 applications for that program this year and 1,300 last year. And we have 250-ish alumni of that program. And they're mostly trained as well. Like if only for capital, we would invest in a whole pile of those. Like we already know
because
them.
They would fit the holding company. And it would
I
fit
can't
Africa
do the
Eats.
forestry ones in Africa Eats, but we have a plan out for Africa Trees that would do the forestry ones.
And so how do you raise money now for Africa Eats, as you didn't do the IPO yet, obviously? I mean, you need scale for that. So how do you raise to get to that scale?
We've raised about $7.5 million so far, all from individuals and family offices. We have talked to many institutions. We expect some to come in 2023, but to date, it's individuals and family offices with relatively small checks.
And you see those institutions as a key, let's say, stepping stone to then be able to take a bunch of the Land Accelerator program, for instance, or to really start scaling to 100 companies?
Yeah.
Or can it grow with just family offices and individuals?
It will continue to exist and grow with family offices. And then it'll step up in scale when the institutions come in, because the institutions are order magnitude larger checks.
And why are they holding back until now? Is it the model, or is it like the holdco they're not used to, or is it just wait and see to make sure you're around?
Part of that,
a couple of years.
Some of all of that, I'd say the biggest driver is we're 2.5 years old. It's not a model they've seen before, and they tend to very, very often ask, give us a 3-year track record. Show us 3 years of operations.
Well, you're almost there.
Can't show 3 years with 2.5 years of incorporation yet, but we'll get there by the middle of next year.
And then how much do you imagine you need to raise to get to an IPO at some point?
The model says about $30 million.
Which is not even that. I mean, it's a lot of money.
To get to London, $30 million. To get to the IPO in Africa, about 10 million more. We're about halfway.
Okay. And I asked this question, I mean, there are many things, but if you had to pick one, for sure you go to impact investing conferences or Africa conferences. What makes you contrarian? What makes you really, is it your optimism for this space, or you're just the view of this enormous blue ocean that's in front of us that others don't see? Or what's the biggest difference? Or is it the model that you see, let's say, with any others when you go to a typical, let's say, impact investing conference or food and ag conference focused on Africa?
I'm still stuck on the word contrarian. I don't see myself as a contrarian. I'm not following the path that others follow, but I don't think I'm following the opposite path. I think what I've done is that I just sat down and said, here's my problem. My problem is there's no exits in Africa. So I can't raise an equity fund like I would if I were investing in tech in the States. So I need another solution. And I found another solution. And so it doesn't look like the other people's because I don't think they sat down and said that. I think most of the other fund managers said, well, there's opportunities in Africa. My choice is debt or equity fund. I'll pick one of the two. The ones that picked equity just picked equity and gave no thought to the fact that there's no exits and their investors are going to be asking them in 10, 15 years, are we ever going to get out? So I don't think I'm a contrarian as much as I'm just worrying about the next step. I'm worrying about it from the perspective of the investors, not just from the perspective of the fund man.
And some of these funds are getting to, I mean, it's not 10 years for them anymore. It's quite a bit less. So investors should start to ask questions soonish, or at least in the next few years, where the exit should be coming.
Yeah, and this is why in Africa most of the institutions are debt, because maybe they did ask the question and the answer was, well, we can't do equity, so we'll just do debt. But then you don't get the right return for the risk. So
you did use revenue-based financing in Fledge at the beginning, if I remember correctly, right?
Fledge uses revenue-based financing, but when we moved the investments over to Africa Eats, we undid that and said, well, no, we like these shares, we want them forever. So revenue-based is another answer, but the challenge that comes on the revenue side, revenue-based investing side, is how do you keep funding these companies over and over again when there's no other institutions that are following you? And so in the Africa Eats style, we are the institution that's following ourselves. So we just do that by buying more and more equity. Fledge gets 6% for its cash and its help. And Africa Eats is aiming for 25% for these companies. And we do that with cash. We just buy shares. And we pay more and more every time we buy shares because the companies get bigger. So that's kind of VC-esque. And so we don't want them to buy the shares back from us. We want them to just take the money and keep getting bigger.
And keep growing, yeah.
Yeah, again, there's...
And anything else? No, sorry, go ahead.
Yeah, I say that the opportunities are so big that you don't, in the case of Fledge, again, it was global. And so it was trying to cover all these things. But in the case of food and ag in Africa, why would you take money out of a company when there's 1,000x growth in front of it? That's just going to slow down its path to get there. We want to put more money into it to go and solve that problem now.
And what do you see? I mean, I know you're not a farmer nor a soil expert, but like the opportunity for regenerative practices in Africa, you say most of it is by definition, but of course there is a lot of chemical fertilizer, either counterfeit or real for very high prices, that is being used by different programs, subsidized by different programs, and being pushed by certain people as the solution. We mentioned Mr. Gates before. Like, we need to get African farmers on high energy and also high cost inputs, because that's the only way to grow. What do you see as, and this might be a rabbit hole, and I want to be conscious of your time, but let's see if we can round it up. What do you see as the regenerative practices and going forward next 10, 20, 50?
Yeah, I said Africa is mostly organic. On the restorative side, I see those answers in the Land Accelerator. I've seen thousands of applicants and hundreds of companies I've mentored. There's some breakthrough ideas that are sitting there in the continent. Making organic fertilizer in 24 hours from ag waste, but they're just not funded yet, or they're barely funded. And so on that side, my nonprofit runs the Terra Fund, or operates the Terra Fund with World Resources Institute. It's a $3 million revolving loan fund provided solely through philanthropy, which is why it's sitting in my nonprofit. And so we've done loans to 20 companies in the restorative ag space. But I think there's just one that's doing fertilizer. Most, again, are either fruits or nuts or moringa or gum arabic. But we have a whole bunch of other companies that hopefully will be able to fund with the next tranche of capital in that fund. And again, hopefully through Africa Eats as it gets bigger. And we would love to see organic fertilizer all over the place at a cheaper price than mined fertilizer. And I think the technology is there to do it. It's just not at scale yet.
Thank you so much. I want to thank you for your time. Be conscious of it, and definitely link everything below, honestly, on obviously on your work, but also keep checking in as the two worlds collide of the Land Accelerator and Africa, or Africa Eats, and obviously follow you over time towards the IPO, because it will be quite a story, and hopefully as successful on the monetary side, but also let's say more successful on the impact side compared to Warren Buffett. But yeah, definitely we'll set an example.
Yeah. All right. Well, thanks for letting me share, and thanks for having me on.
And maybe you even can get your nearby neighbor to convince that organic is not necessarily too more expensive.
Perhaps someday.
Thank you so much for listening all the way to the end. For the show notes and links we discussed in this episode, check out our website, investinginregenerativeagriculture.com/posts. If you like this episode, why not share it with a friend or give us a rating on Apple Podcasts? That really helps. Thanks again, and see you next time.